Hello guys, welcome back to Stocks on the Rocks episode 4. Now, this is actually a special sort of YouTube edition of Stocks on the Rocks. I've decided to trial the new delivery method of the podcast here on YouTube over the next couple of weeks, and you guys will be in complete control of if this actually stays in this format or not. Now, the reason I'm doing this is because I myself, as somebody that watches YouTube all the time, I don't normally commit to YouTube videos that are over 15 to 30 minutes. If I do, I will watch them in multiple stints. I might pause it, go and do something, come back and start again. And then if my browser refreshes, well, it's been lost in the whole of the internet forever, essentially, because I normally don't go back and watch it. So what I've decided to do in this episode is break the podcast up into a few different sections. As you guys know, the podcast is pretty much sort of compartmentalized as we go along anyway. At the start, we always talk about a topic that sort of was relevant throughout the week, and then we go on to answering sort of your questions most of the time. So in this episode, we're going to have this clip today that you're about to watch, and then I will be posting 2 or 3 more videos throughout the week that are snippets from the podcast as well. I'm very much looking forward to hearing your feedback about if you like this format or not. Please be ruthless. I want to know what you think because it's all about trial and error on this channel. Anyway, guys, let's get this video started. Well, for those that missed this week's trade, Afterpay hit an all-time high of $68.62 per share. However, that wasn't the only milestone they reached this week. The Australian Financial Review actually put together a piece, and I hadn't even realized this, where they mentioned that Afterpay had not just breached the ASX 200 and the ASX 100 and the ASX 50, but they have also now breached the ASX Top 20 or the ASX 20. Now, for those of you that aren't aware, that means that Afterpay are now one of the largest 20 companies in Australia. Actually, at last check, they were number 19. Now, that means that traditionally speaking here in Australia, Afterpay are now a blue chip stock. Yep, that's right. You heard it here first. Afterpay is now a blue chip stock. But what I did find interesting was a little later in that article, there was a section where the author mentioned, can this all continue? And I think what he was referencing here was the tech space in general and the kind of influx it's received lately with buy-ups and things like that. And what blows my mind is that some of these fund managers that were quite prominent fund managers all think that this will continue. They're uncertain. They said this will continue. One of them even said something like the underlying growth isn't reflected by economic cycles. Meaning that economic cycles shouldn't affect the underlying growth of this sector, which is an interesting statement, and actually probably something that would be interesting to talk about as well. Now, we've got a couple of issues here that I want to bring up when it comes to Afterpay. The first one is why they actually went from $58 to $69 or whatever it was over the course of a few days. And all this really comes down to a couple of things. The main one, according to this article, is that CITI moved their target price from $24 to $64 as their fair target price for Afterpay. Now, remember, this is a company that is making no profit and heading into possibly one of the worst economic periods since the Great Depression. I mean, CITI have said that they fairly valued this company at $24 previously, and now they value it at $64. And these are rough amounts. I think they both had decimal places after them with various numbers. But they valued this company fairly at $24, and now they believe it's fair value at $64. What has changed? Because last year and the year before, Afterpay had incredible growth. And yes, that growth is accelerating. However, has it accelerated threefold to the point where a sustainable fair valuation is $64? This isn't just like one good week or one great period of 3 to 6 months. They are saying that fair valuation for this company right now is $64. So obviously the market goes, okay, let's buy. And now we're at $69, or we were at last check, or $68.50 or whatever it was. Now, like I said, this company is making no profit at all in one of the worst economic periods potentially since the Great Depression. And we won't know any of this for a long time. But this is what blows my mind, is that The concern here is that we're swimming in a world of uncertainty and pure speculation. And it's creating this ball of hope around so many securities in the world right now. And the problem is that we have a model that is so fresh. We don't know how profitable these companies can be, even with rapid growth. We don't know how profitable they can be in a downturn with lots of debt. We don't even know how they can manage that debt in a significant downturn. And that's why I think this is all going to end in tears. Now, I will say that lightly because I don't think Afterpay are going to go broke. I mean, Afterpay have an amazing business idea. It is, in my opinion, one of the greatest Aussie exports to grow outside of Australia in the sense of this brilliant idea. I mean, as a business owner myself, this is what you dream of. I'm not knocking Afterpay, the company, when I talk about Afterpay like this. And there's always a big difference there. I think a lot of new people that come into the market don't learn to separate the two. There is a company that is doing an amazing job at growing all around the world. That doesn't mean that that company can have any price attached to them. It's not sustainable. Afterpay are an amazing company, great leader, great team, smart heads doing really smart things in that company. You can't take it away from them. So please don't confuse this with me knocking Afterpay. I think it's a great company, but they are significantly overvalued. Not a little bit. This isn't like, Commonwealth Bank is $65 and maybe at the moment with everything going on, they should be $49.50 or $55 or whatever it happens to be. Afterpay are so significantly overvalued that they are way within a bubble territory right now. Now that doesn't mean the bubble's going to pop straight away. Of course, I mean that doesn't mean that at all. But the third point there is the things we don't know. Like I said, we don't know how these companies can handle profit or if they can sustainably create profit. And that's a very popular thing in the US at the moment, is companies that don't create profit but are apparently great companies. The other one is we don't know how they can handle the debt in a downturn. Like, we don't know what they can do if every one of their customers were to be a debtor instantly. And that's obviously a very, very worst case scenario. But hell, why can't I suggest worst case scenarios if everybody buying this stock is saying that it's going to be the best case scenario? I mean, I think they're two. If we're going to meet someone in the middle, let's compare the two. And the next one is moats. There are very, very, very fair debates on either side as if Afterpay have a moat or not. And you know what? I don't think that people that say Afterpay have a moat are wrong. I think it's a fair argument to make. Just like I think that my argument of saying, well, they probably don't if you look at a moat traditionally is also a fair argument. And that's the thing. We don't know if Afterpay's got a moat until 5 or 10 years from now. We don't know if Zip or Klarna or OpenPay or whatever the 1,000 other buy now, pay later providers are going to hit the market will just be coming in on that space and everybody will absorb all of them. We don't know if one's going to become more popular. At the moment, there's no doubt who's more popular. It's Afterpay, with Zip on their heels after their most recent acquisition. But Afterpay is in front. But we don't know. We don't know how effective these moats are, and you can't. You can't know how effective these moats are for quite a while yet. And then that all comes into this little ball of they are trading so far past best case scenario right now with their current valuations. I mean, even if you are basing this off everything going right for you, the math seems to work out that they are at least 4 years away from meeting those valuations. If everything went perfectly, you cannot show me a business where everything has gone perfectly for 4 or 5 years. Even Afterpayers have their hurdles. It's a very difficult thing for everything to go perfectly in a world, like I said, that is far from perfect. And that leads me to my next point is the world is literally shutting down right now. And yes, we don't know how that's going to play out. I mean, Australia seems to be slowly opening back up again. America is doing what America's doing. Like I said before, they had 50,000 new cases in 3 days in a row. We don't know how this all plays out, but somehow everybody is extremely optimistic. And this is the problem I have, is that they're basing all of this off new customer numbers and subscriptions, which is a very fair sort of starting point to base these companies off. But I think people are neglecting to look at why somebody may need creditless money right now. And when I mean creditless, I mean there's no credit checks with Afterpay. So why is it that in possibly one of our worst economic periods, people would be rushing to Afterpay? I mean, think about it, and I'm not saying that it is solely that reason. Obviously, there was growth in Australia under their model long before these times we're in right now. However, there has to be a percentage, and I would guess a reasonable percentage of new clients that are using these accounts because they have no other way of obtaining credit and they're just getting by with it. So I don't know. I'm not inside of Afterpay, but these things have to be taken into account. I mean, this is what is so unreasonable about sectors like this and why I think it's all going to end in tears, because shareholders that are jumping on so late, especially those that have been buying around these levels, they're putting themselves in such a risk-on situation. You have no control over what happens next. You are assuming that this will keep growing because it has in the past, and we don't know it will. And, at this point in time, my guess, and this is a complete guess, it's not advice. I'm not trading off this. I'm not buying or selling off this at all. I won't be buying or selling Afterpay at all at the moment. I think that in the next 36 months, Afterpay will see two different prices or around these figures. I think Afterpay is likely to see $100 in the near future if the market doesn't go to absolute crap between now and then. And I think that they will also see around $25 at some point in the next 36 months. Now, I could be very much wrong. I am just some random guy on the internet. I posted this on my Twitter a couple of days ago, and for those of you, by the way, that might want to check out my Twitter, I'm on there pretty actively. My handle is The Real Hughes, spelt Hughes. There's an interesting story behind that Twitter handle, but we'll get to that another day. But I frequently post on there about shorter topics like this, in regards to Afterpay and other stocks that I think are extremely overvalued and extremely dangerous for new investors. And like I said earlier about Afterpay being a great company, if you're in Afterpay from the early days, I don't blame you for still being in there. I mean, you've got no risk at all. If you're in from $2.95 from when they merged and came back out in 2017, you've got no risk. Well, where's your risk? I mean, they're never going back to $2.90. For them to go back to $2.90 would have something so dramatic would have to happen. Probably a Great Depression when nobody could pay their debts at all and they completely went belly up. That would be the only scenario I could see playing out here that would happen. So, I mean, if you're in from $2.90, I don't blame you. But don't get angry at me for saying they're overvalued now, because they are overvalued now. You can't deny that. There is no logical argument that anybody can give me that says that Afterpay is not overvalued right now. And you have all of the growth commentators that go, but they've got this and this could happen and this is amazing and this is my style. If it's your style, that's amazing. I more credit to you. But a lot of the people listening to this channel and watching this channel are new investors. And you guys want to create long-term successful portfolios. And Afterpay is probably not how you're going to do that. I mean, at these types of valuations, if they were profitable, they're going to be limited to their growth. So you think, okay, well, maybe they're going to be a dividend-paying company in the future. Well, I don't think so. I think they're going to be a growth company as long as they can be until they can't anymore. So what do you get from buying it at $69? The hope that maybe one day they'll be $140, maybe you double your money if they get to $140. And that's a massive if. So anyway, I digress here. I'm ranting. Like I said, I'm just one random guy on the internet, and I've become that guy on the internet that just is the Afterpay bear. I'm the Afterpay perma bear. And the only reason is because if I can convince one person to not buy that share at $69 right now that doesn't understand the company, doesn't have an important strategy behind why they're buying that company, then I'm a happy man. I don't think that everybody should not buy Afterpay. I think that if you're a new investor listening to this right now, stay away from Afterpay. There are so many more impressive investments that if you want to have that type of risk, you could be making right now. I mean, if you're that risk on, look at companies, and like I said, this is not advice, but look at companies like Webjet or Credit Corp Group or, JB. look at them when they're crashing down, because they're companies that can actually sustain their growth. Hell, Flight Centre could be thrown in there. I mean, these are companies that can sustain their growth and can give you decent returns. Sure, you might not go from $8 in March to $69 in June, but that's not how the real market works. For those of you that are new here, that doesn't happen every day. And the people that tell their stories on Twitter about finding those trades are either normally lying, or they just happen to be in that stock at that point in time, or they had insider information, I guess. But it doesn't happen. So set yourself realistic goals if that is you and you're coming into this market as a newbie. You know, you don't want to start off with losses, because you'll just think that it's a scam, or you'll just come out of it thinking that this isn't for you, and it's not. This is the place for you. If you're listening to this channel, the market is the place for you. Trust me, there is a home for you here. You just have to find where your home is and be comfortable.